In this video, we'll be using cost volume profit analysis to calculate the break-even point. What is the break-even point? It's the point where sales revenue is equal to total costs, both fixed and variable. Therefore, it's the point where operating income is equal to zero because total revenues are equal to total costs. How is the break-even point calculated? There are actually a number of methods we can use. One is the income statement approach using a mathematical formula. Another is to use the unit contribution margin. Finally, we can use the contribution margin ratio. Let's start with the income statement approach. We'll use David Inc., a company which manufactures XD2. The company has the following information available for the month of November. The selling price per unit is $1,100. We then have all of the following per unit variable costs. Direct materials of $400, direct labor of $200, sales commission of $30, and administrative expenses of $100. The total variable cost per unit is therefore equal to $730. Next are listed the monthly fixed costs as follows: manufacturing overhead of $86,000, sales costs of $21,500, and administrative costs of $322,500. Total monthly fixed costs are $430,000. What does the company have to sell in order to break even? Which is, remember, when the operating income is equal to zero. In order to use the income statement approach, we have to determine the formula we would use to calculate income. First, total sales revenue is equal to the sales price per unit multiplied by the number of units sold. We're going to use the letter Q to indicate the quantity of units sold. Second, the total variable cost is equal to the variable cost per unit multiplied by the number of units sold, again denoted with a Q. Finally, total fixed costs are equal to, well, total fixed costs. We can now combine these formulas into one income statement formula. Total sales revenue minus total variable costs minus total fixed costs is equal to the operating income. We can expand that into sales price per unit multiplied by Q minus variable cost per unit multiplied by Q minus total fixed costs equals operating income. Remember, Q indicates the quantity of units sold. Remember that the break-even point is when operating income is equal to zero, so we can now replace operating income with a zero. The formula to calculate the break-even point is therefore as follows: sales price per unit multiplied by Q minus variable cost per unit multiplied by Q minus total fixed costs is equal to zero. Let's now use the information from David Inc. in the formula and solve for Q. David's sales price per unit is $1,100, their variable cost per unit is $730, and their total fixed cost is $430,000. We're going to use this information in the formula. 1,100Q minus 730Q minus $430,000 is equal to zero. Let's solve the equation for the letter Q, the quantity that needs to be sold in order to break even. We're going to start by adding $430,000 to both sides of the equation, which will result in the following formula: 1,100Q minus 730Q minus $430,000 plus $430,000 is equal to zero plus $430,000. Simplifying, we see that 1,100Q minus 730Q is equal to $430,000. 1,100Q minus 730Q is equal to 370Q, so 370Q is equal to $430,000. We can now solve for Q by dividing both sides by $370. So 370Q divided by $370 equals $430,000 divided by $370. Q is equal to $430,000 divided by $370. Q, quantity, is equal to 1,162.162 units. How can a company produce 0.162 units? Actually, they can't. We therefore always round up to the next whole unit. This company would have to produce 1,163 units in order to break even. Note that if we had rounded down to 1,162 units, the company would have been in a small loss position. So we always round up to the next whole unit. We now know that the formula method uses the following formula to calculate the number of units necessary to break even. Sales price per unit multiplied by Q minus variable cost per unit multiplied by Q minus total fixed cost is equal to 0. Because, again, break even is where operating income is equal to 0. Let's move on to the first shortcut method, unit contribution margin approach. The formula for this approach is as follows. Q, meaning the quantity in units, is equal to the total fixed costs plus operating income divided by the contribution margin per unit. It's extremely important that we recognize that the denominator in the contribution margin approach is the per unit contribution margin and not the total contribution margin for the company. Using David Inc. again, we first have to calculate the contribution margin per unit, which is the sales price per unit minus the total variable cost per unit. Therefore, $1,100 minus $730 is equal to $370. Remember that the total fixed costs are $430,000. We can now use this in our shortcut formula. Q is equal to total fixed costs plus operating income all divided by the contribution margin per unit. Q equals total fixed costs of $430,000 plus operating income of 0, because we're calculating break even here, all divided by $370, the contribution margin per unit. Q is equal to 1,162.162 units, which we are going to round to 1,163 units. The same answer we calculated under the income statement method. This totally makes sense. The different methods result in the same outcome because we're calculating the same thing, the number of units necessary to break even. What about the last shortcut, the contribution margin ratio approach? The first two methods, both the income statement approach and the unit contribution margin approach, are used when a business determines the break-even point for one product, which is why these formulas determine the units required to break even. However, businesses which have multiple products can't use either of these methods. Instead, multi-product companies calculate the break-even point in terms of sales dollars, total revenue required to break even. This is because it eliminates the problem of how many units each product needs to produce in order to break even. The formula for this approach is as follows. Total sales revenue is equal to total fixed costs plus operating income all divided by the contribution margin ratio. In this case, notice that the denominator is the contribution margin ratio. Recall that we can calculate the contribution margin ratio using either per unit information or total information. Since we have the per unit information available, we'll use that in order to calculate the contribution margin ratio. The contribution margin ratio is equal to the contribution margin per unit divided by the per unit selling price multiplied by 100%. We know that the contribution margin per unit is equal to $1,100 minus $730, which is equal to $370. We can now use that to calculate the contribution margin ratio. $370 divided by $1,100 multiplied by 100% is equal to 33.6364%. If we round that, we see that the contribution margin ratio is equal to 34%. Note that we could have also rounded to 2 decimal places, in which case we would have used 33.64%. But for simplicity's sake, we're simply going to use 34%. We can now apply that to our formula. Total sales revenue is equal to the total fixed costs plus the operating income, all divided by the contribution margin ratio. Total sales revenue is equal to $430,000 plus 0, all divided by 34%. Total sales revenue is equal to $1,264,706. This is the total sales revenue the company would have to earn in order to break even and have an operating income of 0. It is also the total amount of costs, variable plus fixed, because break even is when total revenue is equal to total costs. We have now calculated the break-even point using 3 different methods. Note that the income statement approach and the unit contribution margin approach both calculate the number of units, Q, or the quantity of units we need to sell in order to break even. We have also used the contribution margin ratio approach in order to calculate the total sales revenue we need to break even. Any of these methods can be used to calculate the break-even point, which is, remember, when operating income is equal to 0 because total sales revenue is just enough to cover total variable costs plus the total fixed costs. Thank you so much for watching.